what's the multiple, or what multiple of revenue or EBITDA should I apply to my company's financial results to value my business? Hi, I'm John Taylor, investment banker, founder of Stanton Park Capital, best-selling author of Maximize Your Multiple, The Business Owner's Guide to the Institutional Money Deal. So I remember as a young person, and I think I probably wasn't different than most young people early in my career, getting out of college, and I remember sitting down with my boss in my first job and asking him, I mean, that just kind of like, hey, what's the cliff notes on having a successful career, being successful in this particular job? And I can't remember exactly what all the advice was, but as a young person, I think when you're seeking advice from someone who's a mentor figure or boss, what they might give you, what it sounds like to a young person is, it just sounds like a lot of time and effort, and I'm just looking for the shortcut, right? I think young people, oftentimes you're looking for the shortcut, or what's the fast way to get something done. So you just want the sort of the cliff notes, and you don't want these kind of long things that just sound like a lot of work and effort. That's just boring. You want just a quick answer, right? So interesting, I had a call with a guy last week who called me and was asking about basically like, hey, what's the multiple for my business? Because he was a minority shareholder in a company that had done well, and he wanted to know what it was worth, because he was perhaps going to sell his shares back to the other shareholders. And so he just starts off the call and says, hey, what's the multiple? What's the multiple for my business? And I said, well, hey, look, it's really not just that easy. There's a bunch of things I'd have to know about your business in order to give you a multiple. And it's not, typically it's not something you could just give someone over the phone in a simple conversation. I mean, give them some ballpark ranges depending on a number of factors, but some of those factors that we always look at when we're valuing a company is, first of all, is what industry is it in, right? Because companies in some industries sell for higher multiples or different multiples. It could be revenue or EBITDA. Typically, a software company, a SaaS business, might sell for a multiple of revenue, whereas more of a traditional type business is going to be valued based on a multiple of EBITDA, or earnings before interest, taxes, depreciation, and amortization, right? So the industry matters. The size of the company matters, because there's far fewer large companies in the world than there are small businesses. So if you're a business that's doing over 10 million sales, you're really in the top 1%, I would say, of businesses. So a smaller company are less rare. So if you're a company doing, you wouldn't expect a company doing less than $1 million in revenue to sell for the same multiple as a business doing 100 million in revenue if they're in the same industry. So obviously, larger companies have scarcity value, so they're going to sell for a higher multiple than a smaller business. So that's an important factor. Profitability, right? So if your company's doing less than 10% net, it's probably going to indicate a much lower multiple than a business that's doing 20% profit or more. So profitability is important. What are the growth opportunities in your industry? What has been the historical growth of your company, and what's the growth expected to be going forward? So obviously, a company that has a track record of growth and strong growth of well above the industry average or the economy overall. If you're growing, typical economic growth might be 3, 4, 5% a year, but if your business is doing 10, 15, 20% or more a year, then that might indicate that it's a business that's going to sell for a higher multiple, right? And also, what do the growth opportunities look like in the future, and then how do those tie to what the growth has been historically, and are those growth opportunities credible, and can you prove that those have a high likelihood of working out? Customer concentration is a big factor. So if you have a customer that makes up 25, 30% plus of your revenue, that might indicate a potential risk factor, because if you lost that customer, and if you're talking to a buyer who's going to say, hey, if that customer goes away, then that's going to have a significant impact on the value. So customer concentration is going to reduce the value of a company typically, and it's going to reduce the multiple someone would be willing to pay. I've had talked to business owners who have customers that are 50% of sales or even 100% of sales in some cases. So obviously, those companies with significant customer concentration aren't going to be as valuable as ones that have a more diversified customer base. Things like branding and patents. So brand names, sometimes interesting. I often talk to business owners and say, hey, we've got a great brand name. Our brand name's amazing. Isn't that going to increase our value? And and come to find out their business is doing less than $1 million in sales. I'm saying, well, hey, a great brand is like Apple, Coca-Cola, McDonald's, right? Because they're household names. I mean, brand kind of means you're well known, your household name. That's what makes for a strong brand name. It's not just because you think it's a cool name and you've got a trademark for it and a cool website. Obviously, domain names can be valuable if they have a lot of traffic and so forth. So it's not always so straightforward with that. In other types of risk factors, is there intellectual property? Are there any company-specific risks with employees or contracts or customers, or industry-specific risk factors? Is it a cyclical industry like oil and gas, or a fashion-oriented industry like apparel? Or is it a retail business, right? I mean, some industries are more challenging for buyers than others and investors, and could be more problematic. It could be an industry that a lot of buyers might shy away from. So those are all, those aren't certainly not all the factors. I mean, literally there are 100 plus potential factors that come into play when valuing a company. But really, I mean, those are the main ones you want to think about. But so anyway, I hope this information was helpful. Again, check out my book, Maximize Your Multiple, The Business Owner's Guide to the Institutional Money Deal. Thank you very much.